Welcome to Study Time, a televised home learning program produced by Rwanda Education Board.
Hello students, welcome to TV learning program. I'm teacher Julius. I'll be taking you in entrepreneurship. And we are going to look at unit number 5 of our syllabus, which is financial statements. Unit number 5, which is financial statements. Which is financial statements. So, I want to ask you, what are financial statements? I want someone to tell me what financial statements are. Yes? Yeah, good. Financial statements are financial records that are prepared to show the financial performance and financial position of a business or a company at the end of a given trading period. Yeah, good. So these are financial records prepared to show the financial performance, and financial position of a business. Financial position of a business, or it can be a company at the end of a given trading period. The end of a given trading period. So financial statements, they have got different types. So we have to look at the types of financial statements. Financial statements. So students, you must know that when you are carrying out any trading activity, when you are running a sole proprietorship, or when you have a company, you have to prepare these financial statements at the end of a given trading period. Especially, they are always prepared at the end of the year to help you understand, to help you know the financial performance and the financial position of your business. And therefore, you can base on them and you make some financial decisions. So under financial statements, we shall look at, we have type number 1, we shall look at, so we have the income statement. The income statement, we shall look at the balance sheet. The balance sheet or statement of financial position. Then we shall look at the cash flow statement. The cash flow statement, and we shall look at what you call statement of changes in owner's equity. Statement of changes in owner's equity. Statement in changes of owner's equity. So, from here, we are going to begin, or we shall talk about each, until we finish them. So, we are going to begin with an income statement. We are going to begin with an income statement. We are going to begin with an income statement. So, an income statement, we call it the trading profit and loss account. This can be the trading profit and loss account. The trading profit and loss loss account, the trading profit and loss account, meaning that it contains two accounts, or it is composed of two accounts. It has a trading account, and then it has a profit and loss account. It has a trading account, and it has a profit and loss account. So what is an income statement? So an income statement is a financial statement. So this is a financial statement. This is a financial statement that shows whether the business has made a net profit or a net loss at the end of a given trading period. At the end of a given trading period. So the income statement, as I have told you, it entails two: the trading account, the profit and loss account. So finally, the last element that we shall see in an income statement will be either the net profit or the net loss, the profit for the year that has been made by the business. So in an income statement, the final item that we shall look at in your preparation, it will be either a net profit, that is if the business has made a net profit, or a net loss, that is when it has incurred a net loss. So, as I've told you, an income statement has two accounts: trading account, profit and loss account. So, we have to look at the trading account. The trading account. Before you prepare an income statement, you must know, how can I prepare a trading account? How can I prepare a profit and loss account? Then, when you combine the two, you form one thing which is an income statement. So I want to first ask you, learners, what is trading? Yes? Yeah, good. Trading is the buying and selling of goods with the name of making profits. With the name of making profits. That is trading. So, when it comes to trading, you must know, if you buy goods and you sell them, you need to know, have I made a gross profit or I have made a gross loss? You have to find out whether you have made a gross profit or a gross loss. So, a trading account, for it is prepared mainly to find out whether the business has made a gross profit or a gross loss. So this shows whether the business has made a gross profit or a gross loss. So meaning that in a trading account, we have to look at either has the business made a gross profit or it has made a gross loss. So that is the important thing that we must note. When it comes to a trading account, we must see, has the business made a gross profit or a gross loss? So from here, we have to look at what are the components of a trading account. Components of a trading account. So after knowing these components, we shall use them and we prepare the trading account. Then after finishing the preparation of a trading account, we shall prepare a profit and loss account. Then we combine the two, we form an income statement. So the first element of a trading account, we can talk about the gross profit. Gross profit. So you have to look at this, the gross profit as the first element. So what is gross profit? Gross profit here, this is the excess of net sales over cost of sales. So this is the excess of net sales over cost of sales over cost of sales of a business, over cost of sales of a business. So here, we shall state some formulas which are very important when it comes to this accounting. So here, therefore, it means that gross profit, you will get it when you have net sales, then you subtract what? You subtract what? Cost of sales. Yeah, good. You subtract cost of sales. So this formula is very, very important. So you must note it down. So gross profit is equal to net sales minus cost of sales. You must note this formula very well. You must note this formula. Gross profit is equal to net sales minus cost of sales. What are sales? Here you must know what are net sales, what are cost of sales. So we have to look at net sales. We must exhaust this formula. You know that sales, this can be turnover. What you get out of the sale of goods and services. After selling goods and services, what you have generated, net sales. So here we shall say, this refers, net sales, this refers to actual value. Actual value of goods sold after subtracting or after deducting what you call sales returns or return inwards. You all know that from Unit 10, Senior 5, you talked about accounting of prime books. Sales returns or return inwards are recorded in a sales returns journal, And these goods, which have been returned by customers to the business, they reduce the value of sales. Therefore here, net sales, you get it by having sales minus return inwards. Return inwards. You must note this formula. Why do we say return inwards? These are goods that have been returned into the business by customers because of different reasons that we talked about. Maybe goods here are expired, are damaged, and therefore customers bring them back to the business. So that's why we subtract them from the previous sales made. So they can be return inwards or sales returns. You must note these, learners. If I give you sales returns, you must know that sales returns, they are the same as return inwards. Note this formula. Then we come to cost of sales. Cost of sales. So with cost of sales, in the process of purchasing goods, which you want again to sell, you spend some money. If you go to town to purchase some goods and you want to bring them somewhere and you sell them, there is amount of money that you incur. There is money spent. Money spent on buying them, maybe money spent on transporting them, money spent for loading and offloading. So here, cost of sales, we say this refers to the money spent while purchasing goods for resale. While purchasing goods for resale. When you say resale, it means you want to again sell them. When it is a manufacturing firm, we call them costs of production. The amount of money incurred in production of an item or a product to a commodity which you want again to sell. So there, when it is a manufacturing firm, we call it cost of production. But in this case, since we are looking at a trading account, we call them cost of sales because you are buying goods which you want again to sell. So money spent on them, we call them cost of sales. We have a formula that we use on finding cost of sales. So the formula we have, we shall use this formula. Cost of sales is equal to opening stock. You add what you call net purchases. You add net purchases, you subtract what you call closing stock or closing inventory. So this formula, you must note it very well. You must note it very well. Cost of sales is equal to opening stock plus net purchases minus closing stock. So I want us, from this formula that we have, I want us to look at these net purchases. What are net purchases? What are net purchases? And that is, this was part A, part B, part C. Then maybe we can call this part D. So net purchases. What are purchases? Purchases are goods bought. Yeah, good. Purchases are goods bought for resale. So when you say net purchases, this refers to the actual value of goods bought after subtracting what you call purchases returns. Purchases returns, what we call return outwards. Return outwards. So what are return outwards? These are goods returned to the suppliers by the business because of different reasons that we talked about. Maybe expiry, maybe poor packaging, maybe they have been supplied at a higher price than the agreed one, and therefore the business decides to take them back. That's why they are returned outwards. They are getting out of the business back to the suppliers. So how do you get net purchases therefore? Who can tell me the formula? Somebody to say the formula of net purchases? Yes? Good. Net purchases must be equal to purchases minus purchases returns. Purchases returns. Purchases returns. So if they ask you net purchases, you get purchases, you subtract purchases returns. However, we shall see some adjustments on this. So when it comes to purchases, there are some other direct expenses that are attached to purchases. So what are these direct expenses? We have direct expenses which you add with purchases. So these direct expenses, we have what you call carriage inwards. And carriage inwards is the same as carriage on purchases. Carriage on purchases. So when you say carriage on purchases, you have gone to buy some goods. Then after buying them, you have paid money to transport those goods you have bought to your business premises or where you work from. So in that case, you have to, that money paid, we call it carriage inwards or carriage on purchases. It has been spent on purchases, that's why it is carriage transport, carriage on purchases. So here, money spent, this is just money spent to transport goods bought. Transport goods bought. Transport goods bought to the business. Then in this case, we have other direct expenses like wages. Wages, after buying goods, you have paid some people to help you load and offload, loading and offloading goods, so you pay them. That money that you pay them is a wage, and it is added with purchases because it has been spent because of the goods bought. So money spent for loading and offloading, money spent for loading and offloading goods bought. Goods bought. Goods bought. So in this case, when you have direct expenses like wages and carriage inwards, you add them with purchases. Then you subtract purchases returned. So in this case now you can even adjust net purchases. You can have purchases. When you have, maybe you spent money for transporting goods both, carriage inwards, add wages, then you subtract return outwards. Return outwards. So in this case, you will be able to get your net purchases. You use this formula when you have these two direct expenses. When you have carriage inwards or carriage on purchases and wages, that's when you use this formula. But if you are not given this and this, then this formula holds. Are we together? So we have to look at when you come back to this cost of sales formula, opening stock. Opening stock, the value of goods present at the beginning of a trading period. Closing stock, and a sold stock at the end of the trading period. And remember, the closing stock becomes opening stock of the new trading period. You must note that. But this opening stock is the stock of the previous period. You bring it to the new trading period, then as that very new trading period ends, you must see what has not been sold. That will be closing stock. In a balance sheet, the closing stock increases the value of current assets. So we treat it as a current asset in the balance sheet. Then I want us also to look at what you call goods available for sale. Goods available for sale. Goods available for sale. With goods available for sale, as we all know, goods are available for sale. The amount of goods, the amount of stock that is there for selling in the business. So this is the amount of goods or the value of goods, present for selling in the business. So how do you get it? Goods are available for sale. Goods available for sale. Goods available for sale. It is equal to opening stock. Then you add what you call net purchases. You add what you call net purchases. You must know this formula is very important. Goods available for sale is equal to opening stock plus net purchases. That will be the value of goods available for sale. Maybe you have started the trading period with maybe 20 kilograms. That is opening stock, but they are not enough. You go and buy more, maybe 50. So the total goods available for sale will be 70. Then you start selling. Then from here, we have these different formulas which are very important, which you must note, because when it comes to the trading account, then we shall put these formulas there. Then we prepare. So, I want us to, we have the homework. The question says, the following information relates to the books of Chabitama traders for the period ended 31st December 2019. We have sales or we have that information. I want to do for you Roman 1, because they want us to calculate net sales, net purchases, cost of sales, goods available for sale, and finally they want us to calculate gross profit. So, I want us to use the formulas that we have. Then we calculate these. Because items are given, formulas are given, so it is not very hard. So, on our homework, I want us to do Roman 1. What do I want here? I want you to state the formula, substitute, you put the answer. That is how I want you to do your work. State the formula like this. You will say that net sales is equal to sales minus sales returns. Minus sales returns. I want you to state, this is the first thing I want to see. Net sales is equal to sales minus sales returns. Then you substitute, you look at our question. Do we have sales? Yes, 1,200,000. This is a value of goods that were sold, but customers returned the sum because of very many reasons. We have return inwards, 40,000. So you have to remove, you subtract 40,000. So what will be the answer? Actual sales, actual value of goods sold. We sold these goods worth this, but customers returned the goods worth this because they were expired, maybe because of different reasons. So when you subtract, what do you remain with? Yes, you remain with 1 million, then 160,000 Rwandan francs, currency, it's good. This is how I want you to do it. State the formula, substitute, then put the answer, then you underline. That will be very fantastic if you present your work in this way. So I want you to write the homework and the assignment very quickly. Then you do it. You try it. Then next time I will just mark it. Then we go to the preparation. Try to finish up the assignment. Try to finish up the assignment. Make sure you do it. Then I will just mark it. Then we go to the preparation of the trading. We present what we have seen in a table. We present all these formulas, we present all that information in a trading account. So you make sure you state the formula, you substitute, you put the answer. All formulas have been given. Net purchases. We have purchases minus purchases returns. Depending on the information given, you have to look at it very well. If you have carriage inwards in the question, if you have wages, don't forget to add them to purchases and you subtract this, because those are direct expenses attached to purchases. So if you have finished, we shall meet in the next lesson on the preparation of a trading account. Thank you.